Ladies and gentlemen, good day and welcome to the Indiqube Spaces Limited Q1 FY26 earnings conference call hosted by ICICI Securities Limited. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Adhidev Chattopadhyay from ICICI Securities Limited. Thank you and over to you, sir.
Yeah, good morning everyone. On behalf of ICICI Securities, I'd like to welcome everyone to the mail-in investor call of Indiqube Spaces Limited for Q1 FY26. From the company management, we have with us today Mr. Rishi Das, the Chairman, Executive Director and CEO, Ms. Meghna Agarwal, the COO and Executive Director, Mr. Pawan Jain, the CFO, Mr. Vikas Kumar Agarwal, the Head Investor Relations, and Mr. Vamsi Chatrathi, the AVP Marketing. And now I'd like to hand over the call to the management for their opening remarks. Over to you. Yeah, thank you.
Thank you, Adhidev. Good morning, everyone, and thank you for joining Indiqube Spaces Limited Q1 FY26 earnings call. On behalf of the entire management, I extend a warm welcome to all our shareholders, analysts, and other participants. Since this is our very first earning call post-listing, I would like to begin by briefly introducing myself, my co-founder Meghna, and our journey into building Indiqube. I will also walk you through our business model before we dive into the financial performance for the quarter. A little bit about myself. I did my engineering from IIT Roorkee in 1997, and coming from a middle-class, humble background, entrepreneurship has always fascinated me from the early days in life. I started my first venture in the recruitment space back in 1999, and over time built it into one of the largest recruitment companies in India. During that time, both Meghna and myself were running companies in the recruitment and recruitment outsourcing space. As our teams grew, we found ourselves shifting offices very frequently. In 2013, we leased an office space of 80,000 square feet, out of which 50,000 was used for our own operations and the remaining space we subleased to other businesses and clients. Right from the beginning, we were providing employee-centric amenities like food, transport, gym, and fresh amenities to our teams. And interestingly, what was happening, our tenants also began using these facilities. When we needed the space back for our own expansion, many of them were reluctant to move. They asked us to help us manage their next office, citing a lack of bandwidth and expertise. And despite having no background in real estate, coming to Bangalore as migrants, we took a leap of faith and leased our first independent building on Outer Ring Road in Bangalore. To our surprise, it was fully leased within a matter of 3 to 6 months. That's when we dug deeper, we realized that there was a large market gap between large tech parks and unorganized commercial spaces. There was no concept of employee service or a flexible pay-as-you-go model for growing companies. And so in 2015, Indiqube was born, and our space platform focused on flexibility, employee-centric design, and managed services that scale with companies' growth. Meghna, I would like to hand over to you to share your background.
Yeah, thank you, Rishi. Hello, everyone. I'm Meghna. I come from a small town called Alwar in Rajasthan. I'm a qualified company secretary and also hold an MBA degree. Unlike Rishi, I became an entrepreneur more by accident than by choice. Coming from a traditional Agarwal family, I was driven by the fear of getting married early, and that fear pushed me to work hard and become financially independent. I graduated around the time of the 9/11 attacks, and when the job opportunities were limited, that's when I met Rishi, and together we started exploring the idea of a recruitment process outsourcing company, which is RPO. Eventually, I launched my first business in 2003. Our experience in running businesses and later challenges with office spaces led us to build Indiqube, a platform that reflects the need of today's agile businesses. Over to you, Rishi, again.
Yeah. So over the past decade, we have built Indiqube into an integrated workspace solutions company catering to startups, GCCs, and Indian enterprises. Today's call is a step in our new chapter in our journey. One that is about creating long-term value for our shareholders, empowering our clients, and setting new benchmarks for our industry. We have uploaded our presentation on the exchanges and our website. I hope everybody on this call had the opportunity to go through the same. Our vision has always been to revolutionize how the office spaces are consumed, providing flexible, integrated workspace solutions that enhance employee experience, adapt to evolving workspace trends, and also deliver operational efficiency for our clients. Q1 FY26 has given us a strong start to the year. I will start with our IGAP equivalent numbers. Our revenue in Q1 FY26 was 313 crores, which was our highest ever quarterly revenue, growing at 27% year-on-year. Importantly, 98% of our revenue is recurring, which gives us a lot of predictable and resilient base for future growth. We have registered an EBITDA of 65 crores, growing at a 98% year-on-year. Our EBITDA margin improved by 743 basis points and has reached 21% in Q1 FY26 compared to 13% in Q1 FY25. Also, our IGAP equivalent ROE has seen an improvement of to 27% in Q1 FY26 compared to 8% in Q1 FY25. Our net worth has also increased to 395 crores in Q1 FY26 from 330 crores a year earlier. Notably, our IGAP equivalent profit after tax surged nearly 3 times to 18.5 crores in Q1 FY26 compared to 4.6 crores in the corresponding quarter last year. Our PAT margins also saw a healthy increase to 6% in Q1 FY26 from 2% a year earlier. Our annualized EPS grew to 4.1 rupees compared to 1 rupee in Q1 FY25. Also, I would like to highlight that as per the Ind AS, our adjusted cash EBIT. Now, for us, adjusted cash EBIT is cash EBIT plus income from financial lease. This has grown to 52 crores, and this has registered a 85% growth over the Q1 FY25. And the cash EBIT, the adjusted cash EBIT provides insights into the improved cash flow generated from operational activities. Our robust financial performance, combined with our CRISIL A+ stable rating, underscores the resilience of our business model and our disciplined approach to financial management. Let me now hand over to Meghna to give out our key operational highlights.
Okay, thanks, Rishi. So while Rishi has taken you through our financial performance, I'd like to emphasize that these results were driven by disciplined execution and operational excellence. We adopt or follow the talent strategy. Our expansion focuses on high potential micro markets with skilled talent and strong infrastructure. Our business model is highly adaptable. We customize the offering to suit each micro market, whether it's managing the entire standalone buildings like campuses or operating within large tech parks or even taking up a single floors in prime locations. This flexibility allows us to serve a diverse client base from early stage startups and Indian enterprise to large GCCs, each with their own unique space and a budget requirements. On one hand, we choose grade A locations, and on the other, we take grade B buildings in those grade A locations and transform them into grade A experience through smart renovation. This let us unlock value in underperforming assets and deliver modern workspaces others overlook. Let us now go through the operational highlights of this quarter. In quarter of F26, the first quarter, we have further cemented our position as one of the India's leading flexible workspace provider with 8.7 million square feet of area under management across 120 centers in 15 cities. Compared to the quarter 1 FY25, this represents an additional of nearly 1 million square feet, 17 new centers, and expansion into 2 new cities, which is Kolkata and Mohali. Our occupancy has also improved from 85% up from 81% last year. With an area AUM of about 8.7 million square feet and the rent paying area of 6.5 million, we have over 2.2 million square feet of headroom for growth that is expected to become operational for the next 6 to 12 months. On the demand side, we currently serve 789 clients with a healthy mix of 40% GCCs and 60% Indian companies. These 60% of our clients are sourced directly through our own channels, a testament to the strength and recall of the Indiqube brand in the marketplace. Our focus on large, long-stay enterprise client is evident in client occupying more than 300 seats, accounting for about 64% of our total occupancy. We continue to maintain a positive average monthly net churn of just about 0.16%, a strong indicator of a client stickiness and incremental business from existing customer base. On a technology front, our MyCube app has now crossed 83,000 downloads with steadily growth transaction volume. This reinforces our belief that technology is a key enabler of workspace experience, scalability, efficiency, and engagement. Taking our sustainability mission further, in May 2025, we commissioned the first phase of our 20 megawatt solar farm in Karnataka with 10 megawatt already energized. This generated over 9.8 lakh units of green power in June alone, delivering around 68 lakh in monthly energy savings. And with almost close to 29 green certified centers, we remain committed to creating a sustainable ecosystem for our clients. We remain confident about the opportunities ahead and committed to delivering sustainable growth. With that, we look forward to addressing your questions after the presentation. I'll now hand over the floor back for us to begin the Q&A.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We take the first question from the line of Mohit Agarwal from IIFL Capital. Please proceed.
Yeah, congratulations to the team on your listing and thanks for the opportunity. My first question is, if you could kind of elaborate what is the kind of area addition or seat addition that you see over FY 26 and 27. So last year you added about 1 million square feet. How do you see this number, let's say for 26 and 27? You did mention about the visibility. I heard that number around 2.2 million, but if you could kind of confirm that. And also second part to that question will be that how will you see the area addition within your core Bangalore market and outside the Bangalore market?
So thanks, Mohit, for the question. So as outlined in slide number 16, our FY 26 area under management stands as 8.7 million square feet, while our rent-paying area is currently about 6.5. So this already leaves us with a headroom of 2.2, which I was talking earlier in my this thing. That is about 30% based on the 6.5 million square feet. Most of this area will be available for occupancy or for leasing in the next 9 to 12 months. At 85% occupancy, this translates into an addition of about 1.87 million square feet of potential rent-yielding area without any further center additions. So this is what we see in the next, this kind of a growth what we are seeing right away.
Also, I will refer to the same slide which Meghna talked about. If you look at all the three numbers vis-a-vis Q1 FY25 and Q1 FY26, AUM has increased by 1 million. Same way, if you look at the leased area, that is occupied area, from 4.47 million has increased to 5.54 million. And so we have, as Meghna said, we have a good headroom of almost 33% space, which will get handed over pretty soon. And we will continue to add more buildings. So I think the past data gives you some idea on the momentum. So I think that should continue from here on. And if we look at the revenue, typically, like we have been growing, consistently delivered 30% year-on-year revenue growth, and we expect to maintain a similar trajectory, which will be supported by the new center additions and improved occupancy.
Yeah. And regarding your Bangalore thing, I would, before I answer that question, I would actually give you one more data point of the Bangalore. So Bangalore is the fastest growing commercial real estate hub globally, absorbing 23 million square feet, which we are all aware of. And at 5.7 million square feet, we have almost 21% of market share in the city. These are the network effects at work once you reach certain level of dominance in the presence. It's like saying that we are one of the largest players in the fastest growing market globally, right? That said, the share of Bangalore in overall portfolio for us has reduced from 90% to 65% currently. So we would be continuing in Bangalore. In absolute terms, Bangalore will definitely continue to have a higher share. This is due to the market size of the Bangalore and not due to the lack of diversification. But we would be adding upon the other micro markets also in the future.
Okay, just a small follow-up. So 1 million, Rishi, you mentioned 1 million. So expect that the gross area you could keep on adding 1 million square feet at least. So that's one. And the second is, Meghna, to your point, the 65%, how do you see this, let's say, in the next 2 to 3 years?
So as I said, Mohit, in terms of absolute, it would fairly...
So if you look at cities like Hyderabad, for example, we were almost 70,000 square feet 2 years back, and today we are north of 200,000 square feet. Same thing you look at Coimbatore. We started with one property of 70,000. We are almost about 2.5 lakh today just in Coimbatore. So basically other cities are growing, and we definitely can say that it will, as an overall share, there will be a downward trend with respect to Bangalore. I don't see that increasing. But yeah, difficult to put a number because all cities are growing.
Yeah. And in terms of area additions, I said it's like going up to like 1.5 million square feet. That is what we've been doing in the last few years. We see the similar, as what Rishi mentioned also, the revenue we've been growing at about 30%. We see the similar kind of growth in revenue in the coming quarters.
Yeah.
Perfect. My second question is on your margins, and thanks for sharing the cash EBIT and IGAP numbers. Now, when I look at the margins in both these disclosures, there's a difference of about 400 to 500 bits, right? So just trying to understand that, how do you explain that, and how do we see this going forward in terms of the margins? Also, what will be your guidance on, how do you see the margins? Let's say, is operating leverage a driver for margin improvement, and how do you see the margins improving over the next 1 or 2 years?
Okay. So Mohit, here also you have to look at our margins. It's in 2 phases we've divided. Okay, margin expansion from 13 to 18%, and then from 18 to 21%. All right. So when you come to 13 to 18, our occupancies increased from 81% to 85%, which has been clearly depicted on the investor presentation. That has helped us in increasing the margin. Having said that, while quarterly fluctuations in this occupancy are natural due to the new building additions or ramp-ups, the right lens is to evaluate the full year performance. And when you look at our slides on that basis, we have delivered 18% EBITDA margins in both FY24 and FY25. So 13 to 18% is like that. From 18 to 21%, that margin improvement is largely due to, if you can see, we have a growth in revenue of quarter to quarter, 4% growth in revenue, while our operating cost remains flat, driven by improved efficiency, operational efficiency, as we're all aware of. This demonstrates strong operational leverage, and this has helped us to grow from 18 to 21%. So margin has to look in 2 phases. Hope I'm making it. Hope it's you're able to understand that. And looking at the future numbers, do you need more margin improvement now after so much? Okay, I would say we expect the similar kind of margin improvement. Similar in overall basis in the range of 21%, what we have shown it in the first quarter itself. That is, we kind of will maintain the similar momentum in the upcoming quarters.
Okay. No, I think what I tried to probably, and maybe I can word it differently. So I understand in the 18 to 21 within the IGAP. I'm trying to understand, will this cash EBIT margins of, close to about 17%, and the IGAP margins of 21%, will this converge over time? Is that something that we should...
Converge, it is very tough to say because both the accounting standards are different. It would I would say the difference, we are hopeful that it would reduce, but converging, we are not too sure of.
Yeah, so it will certainly reduce. The gap reduce, but that will continue to be a function of how fast we are growing over there. So when we look at our IGAP EBITDA, the pre-operating and all those kind of things do come into that. But definitely as the base is increasing and we see this converging. Yeah.
Great. That's all from my side. Thank you and all the best.
Thank you.
Thank you, Mohit.
Thank you. We take the next question from the line of Shiv Kumar Prajapati from Ambit Investment Advisors. Please proceed.
Yeah, hi. Good morning, team. First of all, congratulations on your successful IPO. So my first question is, around 80% of our revenue comes from two cities. So just trying to understand what sort of brand power or, recognition we have when we plan to, expand to other cities. And if you could share the market share in Bangalore that we command.
Yeah. Bangalore total stock today is about 27 million square feet. Just 1 second. So if you look at the total stock of Bangalore, about 27 million as per the CBRE data, that is the total stock. And we have a stock of 5.7 million. So basically about 21% market share we have in Bangalore. And similarly, if you look at Chennai, we have the total stock is around 6.5 to 7.5 million, about 7 million. If you take that number, we have just 1 second. We have 1.2 million. So basically about close to 20% market share, 18 to 20% market share we have in Chennai as well. So these two markets, we have a very, very dominant share, and we are among the top operators in cities like Pune as well. Now, if you look at our expansion into other cities, which I said in the previous Q&A also, if you look at Hyderabad, 2 years back was just one center of 70,000 square feet. Today, our Hyderabad presence is 3 centers with about 225,000 square feet. Similarly, you look at any city for that matter, for example, Coimbatore. Coimbatore, again, we had a very similar situation. One center of 70,000, now we have 3 centers totaling 275,000. Cochin, we have doubled our presence in the last 12 months. Similarly, our addition in Mumbai, which was or has almost doubled in the last 1 year. So there is I will say, all-rounded growth happening, typically in a lot of tier 1 as well as tier 2 cities over here, Shiv.
Okay, sir. So my next question is, one of our peers follow the MA model, that is managed aggregation model, which is known to be an asset-light model. So just want to have your view, do we also plan to explore this kind of model going forward, or what flaws do we see in this model?
So basically, we are, as you would have seen, our sourcing strategy has been very, very diverse. As Meghna said in our talk and the presentation also, if you see, 30% of our properties are renovated buildings, where we pick up old buildings, renovate them. We also operate in tech parks, where we take up floors in grade A buildings. We have full buildings also. So we follow a mix of that. And we have also looked at managed aggregation model, revenue sharing model actively. And for some of the markets which are, say, tier 2 cities, or some of the micro markets which are basically very new, where we do not have a very, very consistent track record, those micro markets, to minimize our entry risk, we are exploring the managed aggregation model as well over there, typically. So that is how we see that wherever we see that the risk profile is going to be substantially higher, those places we may not like to take the exposure of underwriting the leasing commitments upfront, and we will look at a MA model as well, yeah.
Yeah, so the micro markets where we are seeing low potential and, as I said, high risk, there we could explore. We have not yet explored. There we could explore, but otherwise our strategy of acquiring buildings has been closer, is basing on the follow the talent strategy, metro proximity, full building or renovated. So there the question of MA kind of reduces. That's all.
Okay. And so my next question is, around 40% plus of our tenant mix is from GCC, and the exposure towards IT and IT-enabled services are around 50%. So what sort of risk we see, given the IT sector, the hiring is freezed or there's not much active hiring, plus few of the companies announcing layoffs. So what sort of risk we see on the GCC front and IT sector? Plus, if you could, share more detail, like 40% of our clients are acquired through other channels. From this 40%, how much is attributable to GCC and how much to, other Indian companies?
Okay. So basically, as you rightly highlighted, that 40% of our clients are global capability centers. Now, 60% are the clients which are typically of Indian origin. Now, we have almost equal mix of all the three segments. There are three types of clients in this. One are basically the IT services companies, as you said. The second segment, which is growing very fast post-COVID, is the Indian companies. You look at companies like Narayan Hirdyalaya, or companies like Mahindra Logistics, those kind of companies. So that segment is also a very, very substantial. We are working with multiple Tata companies now. So those are the places where we see a very substantial presence of the Indian enterprise. And as you know, Indian economy is doing well, so that segment is growing very fast. The third segment that we have is basically companies which are the late-stage startups, the unicorns and beyond. For example, if you look at, say, Myntra, Walmart, they have taken 300,000 square feet from us. We have no broker kind of companies also. So it's quite a good mix. Now, if you look at the specific question about the slowdown that we are seeing in IT, I would like to highlight, if you look at the mid-cap IT is doing better than the large-cap IT. And a lot of our IT services companies of Indian origin are mid-cap IT services companies. That is one. Second thing is, if you look at the top IT companies in India, in the Big Five, the NASSCOM Big Five or Big Ten, most of these people actually do not participate in the leasing market very actively, office leasing market. Most of them have their own campuses, where the government had given them very attractive subsidies in various states and all that. So basically, the active participation of the top 10 NASSCOM companies is limited into the leased office space market in India. So that basically allows us. And also, I would like to highlight that if you remember, when COVID happened, the Indian enterprises were not doing well at all. But the IT services guys, the startups were doing very well because funding was coming in. GCC was not very active at that point of time. So the good part has been that Indian commercial real estate has been very, very resilient. And if you take any data, like 10-year data, 20-year data, the growth rate of commercial real estate absorption has been between, say, 7 to 8%, 6 to 8% consistent growth has happened over there. And if you have to look at the data, because a lot of these large property consultants, their reports, they follow the calendar year. So as per their H1 number, which is Jan to June number, already they are saying 60 million square feet of gross absorption has happened in just 6 months, compared to the total absorption of 65-70 million during the calendar year 24. So people are expecting this to touch 80-90 million by the end of this calendar year. So from that point of view, the growth is robust, and the share of GCCs is definitely growing with us also. But I think overall, the client base for us and the real estate absorption in India is quite diverse. So nothing much to worry about from that point of view. The second one.
And to your second question about that 40% of direct, usually what happens, these through the IPCs and all, these are the global GCCs because they have a mandate globally. So in about 40%, I would say 30% of our, I do not have exact number, but some 30% would be coming from the larger IPCs because these are governed by the global mandates. So when they're opening offices in India, so we have to go through them.
Yeah. So GCCs, the dominant part of the GCCs are coming to the brokers, the consultants, typically. But at the same time, we have a very healthy growth rate of our existing client growing. A good percentage of our growth comes from the existing clients, and there we do not have any brokerage as such to pay out. Yeah.
So the way I think it is, mostly the way to look at it, 1/3 is from the existing client expansion, 1/3 is through the broker community, and 1/3 is your in-house, the new sales. So that is how broadly I would say, the diversification would be.
Yeah.
Great. And my next question is, our current revenue to rent multiplier. Please, can you allow this is the last question?
I understand, sir, but there are already a lot of
participants I'm waiting
for that service. Thank you so much, sir.
Thank you, Shiv. Yeah.
The next question is from the line of Murtuza from Kotak Securities. Please proceed.
Yeah, hi. Thank you for allowing this question. Just two questions from my side. Just want to be absolutely clear. when we talk about the AUM of 8.7, rentable area of 6.5 and occupied of 5.5, rentable is what is operational area and rent paying for you as well? And what would be the delta between AUM and rentable, the additional? Is it leases which are already, area which you've got possession, or it's just something that you're going to get possession of? Or so again, that differential, whether it's rent paying or it's entirely in the rent-free period. So what is the rent paid on? 6.5, or it's a number between 6.5 and 8.7?
No. So you are spot on, Murtaza, that the rent paying area is 6.5. So we are paying rent only on 6.5 million. We are not paying rent on the entire 8.7. And this 2.2 million delta that you see are the spaces where we have signed up, where we have given them some part of the commitment fee, the security deposits, and they will be getting handed over between 6 to 12 months. So if you have to look at our occupancy, the occupancy is calculated as occupied area divided by the rentable area, which is the rent paying area. And yeah, like that. Yeah.
Because you couldn't have potentially leased the remaining straight up because it's still a work in progress.
Correct.
But all of the 6.5 will be operating. I'm sorry, I'm just
Yes.
trying to, because
Yes, very right.
all
It's all operating. Yeah.
Okay. Second question from my side, just to reconcile numbers. Your IGAP EBITDA is 65 crores. Your cash EBIT, a few slides lower, is 48. And then you've got an adjusted cash EBIT of 52. But the bigger one, which is the 65 to 48, can you help explain to us? Because I'm assuming the 65 also takes into consideration the entire rent payment, given that it's an IGAP EBITDA.
Yeah. So basically, there are two parts to it. There's 48 and 52 delta that you talked about. This is on account of the financial, basically leases. Because what we do is we do in some places design and build kind of projects, where basically like these. So as per the Ind AS accounting standard, that is not taken as part of the revenue from operations. It is taken in other income. So that is where we have added it, and we have the adjusted cash EBIT. Now, talking about the IGAP delta and the adjusted cash EBIT. So basically, like, this is a difference of the accounting standard that is there. And as per the IGAP accounting standard, like certain pre-operating expenses and all, we are like, because as you can imagine that when we pick up any client, and when we do the fit out, then it takes 2 to 3 months to do the fit out for that particular client. So those are the pre-operating expenses, which typically are of capital nature, and the way our interiors are capitalized, those are taken care of in that. So that is how you see the delta coming in over there.
Okay, so that differential in your P&L is being expensed, but under IGAP that would have got capitalized. Am I reading that right?
Right. Yeah.
Yes, you're right. But the finance lease, income on the finance lease, which has been clearly mentioned, that it is like your design and bespoke model revenue, which is the actual revenue. But in your NDS, it is used as a other income. So that is why it's been added back. That's 4.
Sure. Now that 4 is the smaller.
Thank you. Thanks, Murtaza.
Thank you. We take the next question from the line of Girish Chaudhary from Avendus Spark. Please proceed.
Yeah, hi, Meghna and Rishi. Firstly, congratulations on the listing.
Sorry to interrupt, Mr.
Again,
Girish.
Thank you, Girish. Yeah.
I would request you to please come closer to your device and speak a bit louder.
Yeah, is it better?
Yeah, better, Girish. Yeah. Thank you.
Yeah. Again, I just wanted to understand your margins as per your business model. What's the center level EBITDA margins for mature centers and what's for the new centers? And for new centers, what's the average ramp-up period which you see from opening to break even? And then what are the corporate overheads like?
Yeah. So there are like 3 metrics. If you look at typically at the overall portfolio level, our center level EBITDA is about 30%, and this is at the overall level. Now within that we have centers which are more than 12 months old, which we call them as mature centers or steady state centers. So there our EBITDA will be average will be about 32% over there. And then we have the corporate expenses. And if you look at what happens is from the time we start paying rent, typically we start getting about 8 to 10% occupancy every month. Between 9 to 12 months, what we have seen is we are able to cross 90% occupancy in most of our properties. And our operational break-even happens between the 5th and the 6th month. That's what we have seen on an average, is where it happens.
Yeah.
And
which is like 5 to 6 months, which is about 56% of the entire building.
Yeah.
And 9 to 12 months, we fill it about 85 plus to 90% of the occupancy.
That's right. Yeah.
Got it. Got it. On the margin side, the difference of 17 crore between IGAAP EBITDA and the cash EBIT, right? If you can, what are the main recurring items in terms of you can quantify the numbers between the various areas which you mentioned, like pre-operating expenses and so on and so forth?
So as Girish, I mentioned that the 4 crores that you see is on account of the financial leases. So basically, that is like a revenue which typically, as per the India's accounting standard, doesn't get covered. So that is a add back. So that is like the adjusted cash EBIT. Now from 52 to 65, we will not have the exact breakup over there,
Yeah.
but most of it will be, I will say, on account of that 2 to 3 months of rent that I talked about.
It's basically like a pre-operating expenses, Girish, and we take the pre-operating expenses of almost average of about 30 to 45 days. That is
So for example, what IGAAP does is that when you sign up a client and you take 60 to 90 days to do the fit out. So part of that period basically is treated as an item of capital nature. So most of the delta that you see will be that, as Meghna said, 45 going up to say 60 days of rent. So basically, that is what you see is within that. Yeah, most of it is on account of that 45 to 60 days of rent for that ramp up period for the area that has got added.
Got it. So this part of the difference between the cash EBIT and base EBITDA, right, will remain subsequently as well, right? See, so how I mean, because you also mentioned about this converging, but
Yeah.
if it's this is so how will this converge going ahead then?
So basically, see the as a percentage, this will converge, Girish, because as you can imagine that today, say our base, our rent paying area base is about 5.5 million, right? Next year, this base will keep on increasing. So today, for example, you are seeing like 65 and 50 to 13 crore delta, for example, and this is like 20% on 65 that you see the difference. So as the base will increase, this number, suppose this will remain around say 10, 12 crores every quarter kind of a number. And then obviously as the base will increase, this percentage will reduce over there.
Got it. Secondly, on the CapEx, if you can just help us understand what's the CapEx budget for the year, and also the CapEx per seat trends which you are seeing in some of the recent additions in the portfolio. And your portfolio average, I saw in the presentation, is around 1,500 per square feet, right? So are we seeing any trend or lower trends coming in there?
CapEx has been a 1,500 rupees per square feet. So the thing what we have done is, this has been, I would say, average 1,500 throughout the years, right? But the cost is not increased, but the quality is increased. So what we've done, instead of reducing our CapEx cost, like from 1,500, so there was a conscious call as a management we took, like instead of doing 1,500 to 1,400, can we improve our quality in 1,500? You know, so similar product can be enhanced. So rather than reducing the cost, we enhance the quality. So in future also, we see that 1,500 remaining almost in the similar bracket. The idea is to that whatever savings we are getting from the economies of scale, the idea is to put it back and improve the interior quality, then reducing the cost.
And I will also like to highlight that this 1,500 rupees is the blended capital expenditure that we incur when we do the new fit outs as well as whatever renovation that we do for assets. Because as you see that 30% of our properties are renovated properties. And when we pick up any property which requires renovation, we have to invest beyond interiors in terms of upgrading the property. So this 1,500 includes renovation CapEx also. So if one were to separate that out, you will see a maybe a 10% basically reduction in the interior CapEx with the CapEx on the renovation over there. And renovation properties basically give us much better EBITDA margins because they tend to come at 20-25% cheaper than the market rate. So the payback on that 150 rupee odd renovation CapEx tends to be quite good over there.
Got it. This is clear, and all the very best.
Yeah. Thank you, Girish.
Thank you.
Thanks.
Thank you. We take the next question from the line of Kshitij Saraf from Tusk Investments. Please proceed.
Hi, good morning. Congratulations on the listing. I just had a couple of questions. Could you help us with the walk from the cash EBIT to the free cash flow in terms of what the operating cash flow would be and the CapEx you have incurred in this quarter and any sort of outlook you would like to share, and what would be the free cash flow for this quarter and the outlook ahead?
Yeah. So I'm getting Vikas, our IR head, to give the answer to this. Yeah, please.
Yeah, hi. So our free cash flow for this quarter is around 35 crore. So on the basis of cash EBIT of 52 crore, we have subtracted our interest cost and tax amount. Then after that, we have add back our non-cash item. On the basis of that, our free cash flow for this quarter is 35 crore.
Okay. And are there any working capital adjustments and
All after adjustment, all working capital and all, this 35 crore is coming to picture.
Okay. Okay. And what is the trend you're seeing in the micro market? So, for example, we have a very large footprint in Bangalore. Apart from Bangalore, because when we see the steady state occupancy last year, that was at 91. This year we see the steady state occupancy at 87, even though the occupancy for our portfolio has increased 5 percentage points. So is there any element of slowdown in the IT sector in Bangalore which is getting captured here?
So very good point that you highlighted. I'm happy about that. So, but if you look at what happened was, basically, there were 3 renovated properties that we added in FY 23-24. And the renovation of these older properties take between 9 to 12 months to renovate them. Now, as per our definition of steady state centers, these properties got classified as steady state in FY 24-25. However, the active leasing of these properties started only in the last financial year. And as a result, you see this, the steady state center occupancy has taken a bit of a dip. Now, these properties have picked up leasing traction. Over the next couple of quarters, we should see an improvement in the steady state center occupancy once the tenant rentals start kicking in, basically like from September, October onwards. So this was more on account of suddenly 3 properties totaling about 2.5 lakh square feet getting added, which basically created a temporary blip. Also, I would like to highlight here that, as Meghna had said earlier also, that when you look at quarter-wise occupancy, depending upon suddenly, suppose some property has become rent-paying or rentable in that quarter, you will see some fluctuations happening into those numbers. And historically, we see that our overall occupancy has ranged between 80 and 85%, and our steady state center occupancy has ranged between 85 and 90%. So I think that is the
the full year is better rather than looking at the year, like the quarter-wise. So full year, more than 80 to 85% in a blended level and 85 to 90 on a mature state. That has been the thing, with the Indiqube.
Okay, thank you. We'll connect offline for more details. Thank you.
Yeah, thank you.
Thank you. We take the next question from the line of Shiv Kumar Prajapati from Ambit Investment Advisors. Please proceed.
Yeah, hi. Thanks for taking my question again. Thanks for having me again. So my first question is, if we look at the revenue to rent multiplier, it is close to around 1.8 times in comparison to others who are, close to 2 times or say 2 times plus. And as a percentage of co-working revenue, if we see rent expenses, it is higher for us. So basically, rent to revenue multiplier is the lowest, and the rent expenses as a percentage of co-working revenue is highest for us among the peers. So could you please help me understand why these metrics are, a bit away from the industry average? This will help to, is there any difference in business model or the market dynamics are different for Indiqube?
Yeah. So, Shiv, I am assuming that you are referring to our slide number 32, where you have the revenue rent ratio.
Let me check once.
Just look at that. So slide number 32, which is the revenue to rent ratio. So for Q1 FY26, our revenue rent ratio has been 2.26.
But sir, for the full year basis, can you share that data? I mean, this is the quarterly, I guess.
Yeah. So full year will be again, I think, pretty similar. Like it will be north of 2 only. Okay. See, it was 1.8 almost 3 years back, typically. Yeah. Okay. And then from there on, it has been continuously improving. And if you look at like Q4, for example, was 2.09. And this particular quarter, and this is on the overall area. So you basically, it's not just the portfolio that got added in that quarter. Right? So yeah, so there is a improvement. From 2, it has become 2.26. And why we are seeing improvement in this is, like one, of course, we pick up a good percentage of our properties as renovated properties. So in renovated properties, the base rents are lower, whereas our revenues are better as a percentage. That is one. Second thing, a large number of properties we manage. We take full buildings. So the common area maintenance and all those things come in under our scope, and those costs are also significantly lower if we were to pay the landlords in terms of CAM and rent and all that. So plus third is basically the value-added services that we look in our case continuously is increasing. Typically, like whatever revenue we are making from our value-added services. So these three factors are basically ensuring that our revenue rent ratio is seeing basically a continuous improvement.
Okay, sir. And sir, currently the income from ancillary activities is about 10% of our overall revenue. Is that correct?
Yes, correct. Yeah, basically it is 34 crores in the FY26 Q1. Yeah.
Okay, so how do we plan to increase this share so that ultimately a realization per seat would be higher?
Yeah. So first we have to look the same slide. You have to look at in the 32 slides. We have divided our value-added services into two components. One is the reoccurring and one is your one-time. So if you see my reoccurring revenue has been increasing on a year basis 35%, and quarter on quarter is about 12.5%. But when you see one time, so one time revenue, which is not reoccurring, is also attributable to depending on the project specific demands. Certain clients would have a certain source. So that thing keeps fluctuating, but a reoccurring revenue, there has been a constant growth. And in terms of like going forward, we aim to maintain a similar growth trajectory in the reoccurring, at least in the reoccurring VAT segment, which we can talk about, because one time, it's very client dependent and very situation dependent. So our focus is on the reoccurring and similar, what we've done so far, 10 to 15%, we'll be doing in the next coming quarters also in the similar range.
All right. And so the last thing is, what would be your churn rate?
Sorry to interrupt, Mr. Shiv Kumar.
All right, no worries. Thank you so much for answering my questions, and best of luck.
Thank you so much.
Yes, thanks.
Thank you.
We take the next question from the line of Karan Khanna from Ambit Capital. Please proceed.
Yeah.
I would request Mr. Karan to unmute and speak.
Yeah.
Hello.
Yeah. Hi, Karan.
Yeah. Can you hear me?
Yes, we can hear you.
Yeah. First of all, congrats on the listing. So I just wanted to understand, like how big is the DNB opportunity for Indiqube, and if you could provide a segmental revenue split for the same.
So currently we have not done this segmental this thing. The DNB also is bundled in the VAT revenue as of now. So I would say services wise we have not yet divided into it, but it is growing at a very healthy pace. We have signed up one very big automobile company in the DNB space in this quarter. So all those things are happening, but segment-wise revenue, which we have not done it, and we do not have it offhand right now.
Okay.
Because in
So
the
in the
totality,
future,
totality we usually contribute to the value add. It's bundled in the VAT services only.
okay, it's in the VAS. Okay. And in the future, you will be open to taking third-party contracts as well in this segment?
Yeah. So VAS is nothing but a third-party contract also. So when we say VAS, the services which we say, whether it is a food or the transport or the D&B, it is also catering to our existing client, but to the non-Indiqube clients also. So it's blended revenue, but nothing to do with which is already part of the leasing, which is over and above. So design and build, as I said, this automobile company which I'm talking about, they were not a part of Indiqube family. It's like a third-party revenue only we are talking. So the value-added services, so it is both Indiqube and non-Indiqube, but it is over and above your leasing revenues.
Understood. Thanks, and all the best for the next quarters.
Yeah, thank you.
Thank you.
Thank you. We take the next question from the line of Anand from My Temple Capital. Please proceed.
Hello. Thank you for the opportunity. I
Yes.
just
Hi,
have
Anand.
one question. Hi. I just have one question. So on slide 24, you've given the impact of Ind AS 116. I just wanted to check. So this is mainly on the cost side. Is there also any benefit that we get on the income side due to Ind AS 116? And what would be the impact of that?
No. There is basically only thing is that there we have the other income that gets classified.
If you see in our if you see the slide number, I'll tell you what the current. If we go to my slide number, your 12th slide. If you see revenue from operation, and if you see our IGAP, the difference in the revenue is hardly 2 or 3 crores. So revenue-wise, there will be income side, there will be hardly any difference. It will be equal. Whether it is NDS or IGAP, mostly the impact is on the cost front, which we have explained in the NDS impact. The revenue, the top line effect is like 1 or 2 crores, which is kind of negligible in the larger this thing.
Okay. And that also, I think if you were mentioning it's coming on the other income side, not in the revenue from operations thing, is it?
Yeah. I mean, yes. Like, for example, if you see...
Sorry. The total income is 324 crores as per Ind AS, whereas the IGAP equivalent is 313. So should I be comparing that, the 11 crore benefit that's flowing in?
No, actually, all our metrics that you see, we have calculated on 313 only.
Yeah.
We have not taken 324 at all.
It is just the reconciliation we have given it.
Yeah.
Like, for example, if you see the quarter for FY25, the NDS revenue is about 307 and the IGAP is 301. So there's only difference of about 6 crores. So that is only for the top line.
So you are right on that the revenue that you should take is 313, not 324.
324.
Okay. Got it. That was it. Thank you so much.
Thanks.
Thank you. Ladies and gentlemen, due to time constraints, we take that as the last question and would now like to hand the conference over to the management for closing comments. Over to you, sir.
Yeah. So I would like to take this opportunity to thank all of you, all the people who took time to join in. I would also like to thank the ICICI Securities for organizing this call. Thank you all.
Thank you. And for the rest of the balance question,
Yes.
The coordinates would be available and more than happy to answer all your questions in detail.
Yes. Yeah. Thank you so much. Yeah. Thank you.
Thank you.
Thank you. On behalf of ICICI Securities Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.
Thank you.